Understanding debt cycles is crucial for navigating the economy. Let's dive into the differences between long-term and short-term debt cycles. The short-term debt cycle, also known as the business cycle, typically lasts 5 to 8 years. First, you have the expansion phase. During the expansion phase, credit availability increases. People and businesses borrow more and spend more, driving economic growth. Businesses expand, jobs are created, and incomes rise. Optimism's high, and investments flourish. Next, we have peak and contraction. Eventually, borrowing reaches a peak. As debts needed to be repaid, spending decreases, leading to economic contraction. Businesses cut back, jobs are lost, and incomes fall. This phase can lead to a recession. Finally, we have the recovery. Banks and governments intervene to stabilize the economy, often by lowering interest rates and increasing public spending. This encourages borrowing and spending, leading to recovery and a start of a new expansion phase. Next, the long-term debt cycle spans 75 to 100 years and involves the accumulation and eventual deleveraging of debt. First, you have the accumulation phase. Over decades, economies grow and accumulate debt. This is driven by continuous borrowing to finance consumption and investment. Debt levels gradually rise as credit becomes easier to access. Phase 2, we have debt peak and crisis. At a certain point, debt levels become unsustainable. The economy can no longer support the debt, leading to a financial crisis. This often requires significant economic restructuring. Next is the deleveraging phase. Deleveraging involves reducing debt through austerity measures, debt restructuring, or even printing money. This phase can be painful with slow economic growth, high unemployment, but it's necessary to restore balance. Finally, recovery and growth. Eventually, with careful management, the economy stabilizes and a new long-term growth phase begins. Innovations and productivity improvement drive the economy forward, and the cycle starts anew. Understanding these debt cycles can help us anticipate economic changes and make informed decisions. The short-term debt cycle explains the frequent ups and downs, while the long-term debt cycle provides insight to the broader economic shifts. By recognizing these patterns, we better can navigate the complexities of this economy. If you found this video helpful, please like and subscribe.